All right, today we're jumping right into one of the biggest debates for any investor, whether you're a total pro or just starting out. You've got a chunk of cash, it's ready to go, so do you go all in at once or do you play it slow and steady? Let's get into it. So picture this. Maybe you got a bonus from work or an inheritance, or maybe you've just been saving up like crazy. That money is just sitting there, and you know it should be out there working for you. But the big question is, what's the first move? What's the smartest way to play it?
Well, it really boils down to these two contenders. In one corner, you've got the lump sum approach. It's bold, it's decisive, it's all in right from the start. And in the other corner, you have the steady, disciplined path, the systematic investment plan, or what we'll call an SIP. These are two totally different philosophies on how to get your money in the game.
And trust me, this debate is raging right now, especially for Gen Z and millennials who are trying to figure this stuff out in a world where financial advice is flying at you from places like TikTok. I mean, the hashtag FinTalk is massive, but it can feel like a total minefield of conflicting opinions. So let's cut through all that noise.
Okay, first up, let's talk about the fan favorite, the systematic investment plan. This is the strategy you probably hear about the most, and for some really good reasons.
So what exactly is an SIP? You know, at its heart, it's all about discipline. Instead of making one giant splash in the market, you're making smaller, regular investments, maybe every single month. It basically turns investing from this big, scary, one-time thing into a simple habit, almost like paying your Netflix bill.
But the real magic, the absolute superpower that makes SIPs so compelling is this really powerful idea that helps you manage risk. And it's called dollar cost averaging.
Let me break this down for you. Let's say you decide to invest $100 a month. In month one, the price of an investment unit is $10, so your $100 gets you 10 units. Simple enough? But then in month two, the market takes a dip. The price drops to $5. Now, this is where it gets really cool. Your same $100 now buys you 20 units. Then in month three, the market bounces back and you buy 8 units. See what happened? By investing the same amount each month, you automatically bought way more when prices were cheap. Your average cost per unit ends up being way lower than if you just bought everything at the top.
This is awesome because it gives you so much more control. It kind of smooths out those wild market swings, and it forces you to build that super important muscle of financial discipline. It really helps take the emotion out of investing and saves you from playing that impossible game of trying to time the market perfectly.
So it's really no surprise that a lot of research points to SIPs being a fantastic choice for investors who, don't love risk and would rather have a more stable, predictable path to building wealth. Case closed, right? Well, not so fast.
Because this is where our story takes a really sharp turn. That logical, safe choice, it might not be the whole picture. So what does the cold hard data actually show us?
2/3. Just look at that number for a second. 2 out of 3. What on earth could that possibly have to do with this whole debate?
Well, here's the bombshell. A huge landmark study from Vanguard, one of the biggest investment companies on the planet, found that historically, going all in with a lump sum has actually beaten dollar cost averaging about 2/3 of the time. Yeah, 2/3.
The data is shockingly clear. On average, across all sorts of different time periods, lump sum investing just has a pretty significant statistical advantage. And the reason is actually pretty simple. Historically, markets tend to go up over the long run. So the sooner you can get all of your money into the market, the more time it has to grow.
And that right there leads us to this massive paradox. If the math says lump sum is the winner 2 out of 3 times, why is SIP so popular? Why isn't everyone just throwing their cash into the market on day one?
The answer has way less to do with spreadsheets and a lot more to do with what's going on up here in our heads. It turns out, the biggest opponent you'll ever face in investing isn't the market, it's your own brain.
So this really isn't just a financial debate, it's a psychological one. You've got the cold, hard logic of math on one side, going toe-to-toe with the powerful and, let's be honest, often irrational emotions of the human mind.
And the heavy hitter in this psychological battle is a cognitive bias known as loss aversion. This is one of the most powerful forces in behavioral finance, and man, it explains so much about why we make the money decisions we do.
To put it simply, as the folks at Truist Wealth put it, losing just hurts more than winning feels good. In fact, research shows that the psychological sting of losing $100 is often twice as powerful as the joy you'd feel from gaining $100. It's just wired into us.
And this bias can absolutely wreck your whole investment plan.
It can make you too scared to take any risks, so you miss out on growth. It's what causes people to panic sell at the absolute worst time, right at the bottom of a dip. Or it can make you hold on to a losing investment forever just because selling it would mean you have to admit you lost.
Okay, so where does all this leave us? We've got one strategy that wins more often on paper and another one that just feels safer in our gut. What's the final verdict here? How do you actually choose your path?
Well, it really just comes down to knowing yourself. Lump sum is probably for you if you have a stomach of steel, if you can watch your investment drop without freaking out and you truly trust the long-term data. But an SIP is probably your best friend if the thought of a huge immediate loss would literally keep you up at night, or if you just want an easy, automated way to build good financial habits.
And this, right here, is the single most important thing to take away from all of this. The best strategy isn't the one that looks best in a history book. It's the one that you can actually stick with, through thick and thin. Consistency is everything, so the best plan is simply the one you won't give up on when things get a little scary.
So we've broken it all down. The math, the mindset, the whole shebang. You get the strategies. But the final and most crucial question isn't about the market, it's about you. Do you know yourself well enough to pick the